Joining me now is Oxbow Advisors managing partner Ted Oakley. Ted, good to see you. Thank you so much for being here. No surprise that the election came up 100 times on calls. This election will mean a change in policy, and that policy will affect corporate America in a big way. What are you expecting?
Well, you know, Maria, I don't know. I mean, it looks like everybody else, it looks like it's a really close race. I think the biggest thing that either one of these will have, though, is trying to do something about addressing, and that's a problem we'll run into, is the debt we have. And I think that's going to be a problem for either one of these. But it's a tough call right now. We don't really look, when we're buying companies, we don't really look at the elections. We're looking at company specific. So it's not something we take in consideration all the time. I'm not saying we don't look at the policy, but we really look at the company or the bond we're buying or whatever.
And what about rates? I mean, look at the 10-year Treasury this morning, as the Federal Reserve is also kicking off its two-day monetary policy meeting this week. That happens on Wednesday, the day after the election. Futures market is fully pricing in a 25 basis point cut again to come on Thursday. This morning, rates are plummeting. The 10-year is down almost 10 basis points, sitting at a level of 4.28%. Following October's job growth slowing sharply. You know that on Friday we learned only 12,000 jobs were added to the economy. Ted, the expectations were more than 100,000 added to the economy, but because of the Boeing strike and the hurricanes, we had 12,000 jobs added to the economy. Does that factor into the Fed this week?
Well, I suppose they think so, but I have to say, Maria, I think the bond market itself, even though it's improved today, I think in general it's telling the Fed that, hey, we don't trust what you're doing. Because if you look at it, since they started the first half point down, you've had rates actually go up quite a bit. And I think that's what they're going to run into. I think they have themselves in a box right now, and they've elected to go low on the front end. That could probably create more inflation. I think that's the problem they're going to have.
Yeah, I mean, there's a lot of speculation that we're going to see another spike in inflation. I mean, look at oil prices this morning, up better than $1 as OPEC Plus has agreed to push back the December production hike by 1 month. The second delay to this plan to revive supply. And you've got the price of crude right now at $71.56. That's up 3% this morning, Ted. Is this an indicator that inflation is going to have a second spike at some point?
Well, I think it would. You know, one of the things you look at is, yeah, the goods part of inflation has come down, Maria, but if you look at services, they've stayed high all along. And people are just not getting that move down in inflation that I think people think you're going to try to get back. And if you look at the terminal rate of interest right now, in the marketplace anyway, it's 100 basis points higher than what they thought it would be. So obviously they're factoring in inflation right now.
Mm-hmm. Mike, jump in here.
Yeah, Ted, it seems like the futures have a 100% chance of a rate cut coming this week and in the mid-80s coming again later this year. If inflation is still elevated and we're somewhere in the 2.5% to 3.5% range, would it still make sense for the Fed to go ahead and get the front end down to 4% to maybe relieve some pressure on the long end of the curve and maybe loosen up the banking system a little? Because it seems to me with the gap between the 10-year Treasury and the 30-year fixed mortgage at, you know, an extra 100 or 150 basis points from where it should be, that it makes sense for the Fed to cut no matter what.
Well, you know, Mike, I think you're right. I think the thing, though, is I think they're thinking about what it costs the government to operate right now as far as interest costs, and they've elected to go the other way. They've elected to drop the rate short term. And it gets back into that thing about financial repression, where you get into a repression, where you get into a situation where your rates are lower than inflation. And that's how you get away from this $36 trillion in debt. Whether that's what they're trying to do perfectly, I don't know. But I think that's about the only idea they've got that could make it work.
Real quick, Ted, would you be buying stocks here going into year end?
If we had stocks that fit our criteria, we would buy them. Maria, right now we're running about 40% in treasuries. But when we have a company that hits the numbers we want, we would buy, yeah.
All right. Ted, we'll leave it there. Great to see you this morning. Thanks so much.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe and you'll see more of what we do here at Oxbow.